Hey guys, it's Carl Allen. Welcome to module number 7, lesson number 4 of Dealmaker Empire. And today's lesson, we're going to go through the entire financing process. And I'm going to show you where financing dips in and out of all the different things that you're doing. You're going to see a little bit of a refresher on some of the key things that you've already done and also some of the key things that are coming up next in module number 8, which is all about deal execution and closing. So the financing process overview is 20 steps. So here's a snapshot. And I want you to take a minute to read through them all because we're going to get into each in detail. Okay, good. So now let's go through them all one by one. As we've discussed, step number 1 in your financing process should have started kind of early on in your business buying journey. Ideally, you began contacting potential financiers right after you nailed down your deal specification and began looking for strategic bolt-on opportunities. And there are 2 reasons for this. 1 is that they're going to have access to deal flow. And 2, it's really important that you start to build relationships with financiers as well as brokers and CPAs and lawyers and all the other people that you will need to get deals closed. And the stronger the relationships you have, the more likely your advisors will be there to go that extra mile on your behalf. So when it comes to financiers, step number 2 is to get them on board early by having a meeting or a call with them and telling them your story. Tell them why you're in business, why you're looking to make acquisitions, and really sell your experience in and your passion for your industry. Because again, you want them to invest in you, my friends, in helping you do deals to build your empire. So really get into that rationale. Show them your deal specification, 1 sheet, talk them through it, show them what you're looking to do, show them the numbers. Don't be shy. They'll get really excited that they're going to be part of your revolution. So your goal from meeting financiers so early is step 3, to get something called a comfort letter or a comfort email that might look something like this. And I've blocked out the details, but this is one that I got recently. So Carl, good to meet you last week. Although you haven't identified a suitable business to acquire yet, I'm looking forward to engaging on a deal with you in the future. And I'll send you our initial documents list separately. Keep in touch. Regards, Martin. And Martin's now a very good friend of mine who's financed lots and lots of my deals that I've done. And meeting with financiers and getting those comfort letters can go a long way once you start speaking to brokers or sellers, because they may immediately ask you, so what's your financing strategy to buy my business? And who you've got in your corner as a financing partner. And being able to share these comfort letters or emails shows them that you're credible and you've got financiers in the wings ready to do the good deals that you bring them. But before you even bring your financiers a deal, be sure to go through their basic terms in step number 4. If they're going to finance the assets, say on the balance sheet, make sure you understand what the terms are going to be, and everyone's different. What's the basic interest rate? What's the premium? What's the typical length of the loan? The maturity? Is it a cash flow lend, or is it a lend secured against those fixed assets? Find out what the repayment term is. Is it 5 years? Is it 10 years? If it's real estate, could be 10 years, could be 25 years. Talking to the SBA, it's typically 10 years in a 7A loan, but could be 25 years in a 5 or 4 loan. And remember, with things like accounts receivables and inventory financing, those are revolving credit facilities. You don't necessarily have to pay the principal back that you're borrowing to buy the business. You're just revolving those facilities and paying the interest to continue trading the business. And also ask them about fees. Most of them charge closing fees. So what are they? What recurring fees do they also have? And if you're talking to equity investors, which we went through in the last lesson, ask them what their typical valuation range is. If you're talking to angel investors, they're normally up to, say, $10 million deals. If you go into a venture capital or a private equity company, they usually invest in way above 10 million deals, sometimes over $25 million deals. And as I mentioned in the last lesson, really drill into what the value the investor can add to the growth of the business. Then look at what kind of metrics that they use. So equity investors will be capped at a certain multiple of EBITDA, typically around 5 times. Otherwise, it just gets too pricey for them. They won't get the returns that they're looking for. And also, they generally don't want to own more than, say, 40% of the equity of your deal. So also drill in to what the equity terms are. They might have something called an earning equity, where they're providing funding for you in drips rather than giving it to you all at once to do the deal. And don't forget, whether your financier is an equity-based or an asset-based lender, tap into any deal flow that they may have. Show them your specification one sheet and say, hey, do you know any businesses that would fit these requirements to spec? And highly likely they're going to know businesses that are around, and these are probably going to be off-market deals. So with step 5, you're now sourcing deals. So when doing deal origination, you're talking to people. If you need to, leverage those comfort letters and your new finance partners for extra credibility. And not just them, connect them on LinkedIn and leverage their networks as well. There might be other financiers that you can source, because all financiers tend to be connected to each other on LinkedIn. And once you connect with them, it gives you more options, gives you more good shots on goal. And in some cases, for larger deals, you might want to take your financiers with you to the meetings or even have them on the Zoom calls. Now, I really do that, but some of our students have leveraged their financiers in this way, and it's really helped them get deals closed, and it can help further the rapport, the trust, and the credibility that you've already built by having these people alongside you with the meetings. But remember, you've got to position yourself as that safe, credible, trusted pair of hands to take the business on. And your goal, whether you've got the financiers with you or not, is to get that NDA signed, and then you can extract all of that financial information. This is a typical NDA example from a broker. They're very, very basic. And I've signed tens of thousands of these in my career, and I never really give them to my attorney or my lawyer. But if you want to do that, that's absolutely fine too. Then when you solicit the information, if you're speaking to financiers early on in the process, each financier will have very different requirements, though there's a standard set of stuff that they'll require. You typically want the last 3 years of accounts and the tax returns, and you're always going to want to see the interim accounts for the current year. So if you're looking at a deal in June and you want to see what's happened in January through May, just make sure that the business is on track and nothing negative's happened since you've got that last full set of numbers. You'll also definitely need the latest balance sheet, especially if you're doing asset-based financing, as well as the specific information on the assets that you're going to need to leverage. So for example, if you're doing AR financing, accounts receivables financing, you want the up-to-date accounts receivables report. If you're financing the inventory, you want an inventory report. For fixed assets, you want their current depreciated value. Then you're also going to want all the legal and ownership information of the business. Is it an LLC or an S Corp in the US? Is it a limited company or a partnership in the UK? Is it a PTY in Australia? And finally, you'll want to find out who all the shareholders are and what percentage shares do they actually have. This is all in the basic information request, but it's worth repeating because it's really important that you get this stuff. Now you're ready to make your offer. So in Module 6, I talked you through why and how you need to sequence your offers. Then in Step 11, you'll get into the negotiation, starting from offer number 1 and moving down your sequence every 3 to 4 days as far as you're comfortable going to get the deal agreed in principle. And remember, it's a numbers game. You start off with a big pool of leads. You qualify a lot of those leads into deals that you would likely do. And just a reminder of that, it's also really about leveraging that seller psychology and understanding the advantages of doing the deal for them. It's because they want to retire, or they're going to move on to something else, or they're frustrated, depressed, burnt out, whatever it is. With you, they get to monetize their life's work by selling you their business. And where you can really make a difference in negotiations is when you uncover those deeper emotional benefits, the pride, the erosion of fear of meeting expectations, giving the seller a better work-life balance so that they can spend more time with their family, that loss of pressure or being able to retire or do something else. And by using the negotiation framework I took you through in module number 6, you'll find that offer that works. In this example, we got to offer number 3. And once a deal's agreed in principle, we hit the uncharted territory of step number 12. We get into this in greater detail in module 8, but we send and agree on something called a letter of intent, an LOI, or in Europe, it's called a heads of terms or in Australia, an MOU, Memorandum of Understanding. So with the letter of intent done, you submit all the information that the financier needs to do their basic analysis. They'll come back to you with their own term sheet, that expression of interest, or sometimes called an EOI. And once you've got your LOI that's signed and you've got the signed term sheet from the financier, then you're ready to move on to the transactional phase, because as soon as you've got that signed LOI and the term sheet or EOI from the financier, that financier is going to start their full due diligence process to secure the financing and get the deal closed with you. And they will want a lot more information at this stage as part of their due diligence. What they want will depend on the size of the deal, the type of financing, and actually the specific lender that you're using. They're all different. Now, it's all about shadowing their process and getting them access to all the information that they need. If you're using equity investors or cash flow lenders or the SBA, they're going to do a lot of detailed financial due diligence, and you can always kind of piggyback onto that. It can save you having to use an advisor to do a lot of that work yourself. Now, I always do my own due diligence, or I hire a contingent fee CPA to do it, but you can use a lot of the financier's due diligence reports as well, and then maybe top that up with a little bit of extra stuff that you want to do. But you still need to do commercial and legal due diligence, which we'll get into again in module number 8. Now, your lawyer is obviously there to advise you on the financial legal contracts. You could do the commercial due diligence yourself, though the financier might want to see that. That's why I really like doing commercial DD myself, because it really helps me understand the market and the business and the growth opportunities. And obviously, if you're doing a bolt-on acquisition in your industry, you're going to know a lot of that industry information really, really well, because you're in it every day. But you're just looking to make sure, as part of your commercial DD, that this business is going to do all of the things that you want it to do once you bolt it into the business that you've already got. Step 18 is when the transactional work commences. Once you've done all of the due diligence, your financing and terms, they may end up changing, and we get into this in a lot more detail in module number 8. But for example, you might find out that the business isn't as profitable as the seller portrayed. Say they weren't accounting for expenses in the right way, or the balance sheet didn't have all the correct assets and liabilities. There can be some tweaks to the overall valuation and deal structure, and a lot of that can be driven by the financier. They may look at the business and feel the assets maybe not worth as much as what they were listed for on the balance sheet, so they'll need to offer you less money. And if they're lending you less money, you might need to change the deal structure and revisit some of those original negotiated terms with the seller. And as I mentioned in the negotiation lessons, you can use the financier as your bad cop. You can say, look, Mr. Seller, I'm sorry, your business isn't worth as much as we thought. Your assets haven't been valued as much as we thought. That's impacting my ability to raise the capital to do this deal. We're going to have to go back to an earlier offer and renegotiate. And it sounds daunting, but that's not as hard as it seems, because at that stage, if you've built a relationship with the seller and they're really vested and they're emotionally committed to selling the business to you, maybe they've even started mentally spending the money, so you can more easily dial them back if the gap's not too large. And once your final terms have been determined by the lender, you might get a revised term sheet, which again is a big weapon that you can use to renegotiate any deal with the seller. It's like you agreeing to buy a house, going and getting a survey from a house loan provider. The survey comes back, the house is worth less. You can go and you can whack the seller over the head with that report and say, look, your house isn't worth as much as you said, we've got to renegotiate. It's the same with a business deal. Now, your financiers will give you legal documents that include something called financial covenants, which are the rules about how you must financially operate the business. So we get into that in more detail in module 8. You may also go through something called a take-on process, especially with asset-based financing. This really comes into play when you're using revolving lines of credit for inventory and, say, accounts receivables. And what happens is cash receivables and inventory, they're changing on a daily basis, in fact on an hourly basis in some businesses. The day before closing, the financier will do what they call a take-on. They'll determine what the exact levels of those assets are, and then they'll tell you what the final loan amounts are going to be. This is why we set working capital numbers as part of the letter of intent, the LOI, so that we keep the assets in the business as close as possible to what we need to get the deal done. And again, we'll get into that a lot more detail in module number 8. So once all that's been done, funds then get transferred. They get transferred into legal escrow for closing until you physically sign the documents, the sale and purchase agreement, to take ownership of the business. And as soon as you've signed those documents, you now legally own the business and the money flows through the system. So that's the 20-step process that you need to go through for raising financing. Obviously, we future-paced some of the things that are coming up in Module 8, and I recapped a lot of the things that you're already doing, like deal origination, financial modeling, deal structuring, making offers, negotiating, all that great stuff. And I did this because I wanted to show you how the financing overlays a lot of the different things that you should have already been doing as part of this process. So that's the final training lesson for module number 7. Coming up next is the implementation lesson, where I'll review all of the key teachings from this module and set up your homework, your assignments, before moving on to module 8. And I will see you soon in the implementation lesson. Until then, bye for now.